Market structure should be the foundation of your analysis. The first part of any trading plan is to establish which side of the market is in commanding position, buyers or sellers, demand or supply. Today we'll talk about that, the market structure, and you'll learn how to read charts correctly. So if you could, like, subscribe to the channel, and stick around for the full video. When reading market structure, you have to pay close attention to one thing on the chart: price. Price will tell you all you need to know. When price is moving influenced by supply and demand, this creates trends. A bull trend is depicted by higher highs and higher lows. The trend will continue in that direction until a lower low is printed by the asset price. The trend begins to show signs of weakness when it fails to print a higher high. A bear trend is the price action of lower lows and lower highs. The bear trend will continue to fall as long as lower highs continue to print. Once a higher high comes into the price, the trend will end. The sign that the trend may be reversing is when the price begins to print higher lows or equal lows. A sideways trend is a trend that has equal highs and equal lows. Price trends in a range during this point of the market and is in consolidation. Markets can move in a period of consolidation for a long time. This trend is broken if the price breaks out from the top or the bottom of the range. This could be the beginning of one of the first two trends. These are obvious concepts regarding market structure. Now let's go deeper and let me share the subtleties of the market structure. The first principle is the most obvious one. For a market to be in an active cycle, its most recent structure must be one where price prints a high that breaks the previous high. This is the case of a bullish cycle. A down cycle will be established if the latest swing low breaks below the most recent low in price. In this hourly chart, you can clearly see the market is in an upcycle phase on higher highs and higher lows. To confirm that a bullish trend or an upcycle is evolving in a healthy manner, not only we need to see the high printed being higher than its previous high, but we also should expect at least several closes above that high or support area as further evidence that the market is accepting and building value. Failure to print at least 2 or 3 closes above that high may translate into a false breakout. And while the move still holds its merit to qualify as a new high in the cycle, the quality of the leg is poor in nature. You must avoid the trap of being short-sighted by only sticking to one chart analysis. When conducting your market structure analysis, it's all about finding confirmation from higher timeframes down to your trading timeframe. What this means is that if you are going to find an entry trigger on the hourly time frame, you should then understand what type of conditions are dominant in the immediately higher time frames. The most popular in this case would be the 4-hour and the daily charts. A major mistake made by traders when analyzing market structure is allowing too much guessing play a role in their analysis. When analyzing the charts, how do you determine a relevant swing high or low? Is it this one or this one? Which is more relevant? That's why you need to find a mechanical approach that will allow you to qualify a relevant swing high or swing low in the chart. Here's my general rule. If a swing low or high doesn't make it to at least the 50% Fibonacci retracement of its previous swing, I disregard that price movement as not relevant enough to represent a valid leg. I only want to focus on the creation of relevant and valid legs that will lead to new cycles and create in the process relevant levels of support and resistance. We'll talk about this later. Markets don't always trend, and you'll come to the point in the market structure where the dominant trend starts drying up, maybe due to increased profit-taking, removals of liquidity, intervention by market makers, or economic data-driven moves. While in an upcycle, the interpretation of the market structure is straightforward. You must determine when you have transitioned from a trend into a consolidation. We'll cover an uptrend transitioning into consolidation. Firstly, you must see a failed test of a valid high. Price is unable to break the recent high. Secondly, a failed test of the most recent swing low would confirm that we have entered a consolidation phase, which would last until the most recent valid high or low is broken, with at least several closes above or below the level. In this context, don't forget that the consolidation is within the context of an upcycle. Until sellers manage to break and hold below the latest valid swing low, the trend remains to the upside. Another major sign that will help us determine the health of the cycle is the type of progress made by the dominant side in control of the cycle. You need to ask the following question: are the new legs in the cycle increasing or decreasing in magnitude? Here, despite having entered a period of consolidation in the hourly chart, if we measure the latest swing high, if we measure its extension from the last low to the newly established high, we see that this is a bigger advance versus the previous up leg. This means that buyers are increasing their commitment on each new cycle, meaning greater demand imbalances. Therefore, this is yet another clue that the trend is to the upside. When it comes to the distance of the price moves, the magnitude is only half of the equation. The other one has to do with the velocity of the move, or the speed. Was the new leg created after a fast and impulsive move? Or did price make a new low or high with the movement being sluggish, compressive, and taking too long to form? A good rule of thumb is to count the approximate number of candles it took to achieve a new leg. In this case, you can see that the second leg was created with a lower number of candles at a faster speed, so the cycle continues to prosper in a healthy manner. A reliable measure I have found to set targets when trading cycles is to measure the 100% Fibonacci projection from the most recent valid swing low to its high. In TradingView, you can use this tool, Trend-Based Fib Extension. You need to join the lowest, the highest point, and the low of the retracement or the pullback as the third point. For example, looking at this chart, we are in an upcycle. The first point to draw the Fibonacci extension would be at point A. The point B would be here, and the third point will be here, at the low of the retracement. This will give you the 100% Fibonacci projection and other probable resistance levels where the price may face resistance in the near future. If the cycle continues in the expected direction, you will start to appreciate the power and the usefulness of these targets to consider taking profits or trailing stops in the hope of a larger profit for your trade. In this example, notice how this target was reached almost to the pip before buyers took profit. Another important exercise you must perform is to draw the most immediate lines of support and resistance, at least 2 up and 2 down, based on a top-down analysis. They should be obvious to spot. Here, you must take into account the number of times the area has been tested, ideally minimum 2 times, the type of reaction away from this area, the stronger, the more relevant, and the time frame. The higher the time frame, the more significant the level is. Here, I've drawn the 2 most immediate levels of support and resistance in the daily and the 4-hour. What this means is that if you are going to find trades on the 1-hour time frame, you must be aware that once the price reaches these areas in the higher time frames, a potential reaction in the structure in your trading time frame, the 1 hour in this example, may occur. So you must be aware by anticipating this potential outcome. Marking these levels in your chart allows you to know when to expect a potential reversal. If you followed me this far, you now understand that a new cycle would be confirmed if we can break and have several closes outside of a range. However, what if we break the current range, but we are faced with another recent low immediately ahead? If the distance is relatively narrow, a safer approach is to wait until a breakout of the most distant level in that cluster of support areas, which would be several closes below the second level, to confirm the down cycle. Essentially, when this situation occurs, what you probably want to do is to expand the size of the range and wait for a breakout outside. So how can you trade these cycles? First, assuming you are trading off the hourly chart, you want to make sure to trade also in line with at least the immediately higher time frame cycle, the 4-hour, and ideally both the daily and the 4-hour. You also want to double check that the hourly market structure is trending with several closes beyond the last valid swing low or high to confirm a new leg in the cycle. It's important that you then check the absence of nearby cluster levels from higher timeframes or economic data releases that may disturb the structure. And pay attention to both the magnitude and the speed of the creation of a new cycle. If we are in a healthy cycle with lower lows, for example, decent magnitude moves, and no obstruction of higher timeframe levels, pay attention to the 50% Fibonacci retracement of the correction. The 50% retracement is a great location to start looking for trades based on your ideal entry technique. Some traders may prefer to set limit orders at this level, with a stop a few pips away from the most recent high. Others may prefer a confirmation trigger, such as a breakout of a trend line or a particular pattern, like a flag or a triangle, for example, or a specific price action formation, such as engulfing bars or pin bars. Whichever way you approach your trades, the area you are looking to trade from must hold value on the basis of decent risk-to-reward prospects. You can alter the entry approach as you wish. I personally like to find entries at the 50% Fibonacci retracement, but you can also wait for entries at the area between the 50% and the 61.8%, also known as the Fibonacci Golden Zone, or at the 78.6 Fibonacci retracement. In fact, a great pattern for a potentially large risk-to-reward is to be on the lookout to trade a retracement at the 78.6 Fibonacci retracement within the context of a strong and healthy cycle. These trades tend to offer the best opportunities with a narrow stop and a larger profit potential. Fibonacci extensions are a great way to establish price targets or to find projected areas of support or resistance when the price is moving into an area where other methods of finding support or resistance are not so evident. If you are long on a trade, for example, and a new high occurs, you can use Fibonacci extensions for an idea of where the price may go. You have the option to decide whether to cover the position at that level. I prefer the 100% Fibonacci projection, and the next important one is at the 161.8 level. This is the simplest way of analyzing a market. The big advantage in analyzing market structure this way consists in keeping your charts clean, uncluttered, and away from unnecessary indicators. And of course, some degree of subjectivity will always be required. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.